Before we start, I'd just like to say a quick thank you to our podcast sponsor, PensionBee, who are one of the UK's leading online pension providers. Now, PensionBee can help you transfer most of your old pensions together into one simple and low-cost plan, all through their app and online platform. Now, if you're looking for a low-cost, hassle-free way to consolidate your pension pots, except final salary pensions, that is, then PensionBee is worth considering, especially as it does not lock you in with exit penalties, which I really like. That's because it leaves you free to move your money at a future date if you so wish. I think it's a combination of investment fund performance, low costs, and its slick app interface, which has been integral in PensionBee gaining over 250,000 customers and receiving an excellent rating on Trustpilot from over 1,800 reviews. Now, you can sign up with the names of your old employers in 5 minutes. PensionBee's plans are managed by the likes of BlackRock, State Street Global Advisors, Legal & General or HSBC, and as always with investments, your capital is at risk. For more information, go to pensionbee.com.
Hello and welcome to episode 265 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing?
I'm good, Andy. It's good to be back on the show. It's been a busy week. I mean, at the moment, we're just flat out, aren't we? It just feels, because of the uncertainty out there financially and everything like that, and things are moving at such a pace. I'm not just talking about even investment markets, I'm talking about the things that the government are doing and just the economy, that with so much stuff that we're doing, content, I feel like I've never done more video or audio than this period of time in my life. So it's been brilliant. It's been fantastic to be able to help more and more people. But you feel at the end of the week that you're feeling quite tired. I don't know about you, Andy, but it still feels pretty relentless. But it's good because we're getting out there to a lot more people. And this week's podcast is actually based around one of the things we did this week, which I might as well speak about it now, mightn't I? While I've started, we've been getting a lot of questions about the impact of the coronavirus on lots of different things. I'm doing weekly Q&As in the Facebook group where people are sending in questions, and this week I thought it would be good to do a mortgage one because we'd been having lots of mortgage questions, because understandably there's people who are unable to pay their mortgage, or people who are wanting to move, in the middle of trying to move. Maybe were about to exchange before the lockdown hit. Maybe they were hoping to remortgage, or they had plans of moving in the future. There are so many moving parts to the property market and the mortgage market. I mean, another thing was there was news being broken all the time about lenders pulling out the market, valuers not being able to value properties, prices may be falling. And what I wanted to do was try and give an answer to a lot of the questions that we're getting in. And Habito, who are an online mortgage broker, we've done bits and pieces with them in the past. They were actually on our, one of their mortgage advisors was on our live event panel, and we got together and we done an online piece. We did a YouTube live. We did it on YouTube because it enabled me and Will from Habito to be side by side and me asking the questions. We got a lot of questions from people within our Facebook group via email as a result of a newsletter we sent out last week and social media. And I put them to Will. And obviously it's a fantastic piece of audio. So we decided that not everybody's going to obviously watch our YouTube channels. Or maybe be in our Facebook group. So we put it out on the podcast this week. So it's going to be the lion's share of this episode. And it's everything you really need to know, or any questions you've got about the mortgage market and about your own personal situation. We will almost certainly have covered it in this episode. So Andy will put the questions that we cover in the link of below the show notes. You can do that, can't you, Andy?
Yeah, that's right. I'll make sure it's all on the show notes so people have got access to that.
Yeah, and it'll allow people, if they want to, they can jump forward. Not that I want you jumping forward in our podcast. I want you to listen to every word that we say. But obviously you have to be slightly forgiving on the sound quality, because as we did this remotely on, let's just say live, you get elements of sound dropping in and out. You'll hear me paraphrase a bit where will disappears for a second or two. So we're going to lead into that in it shortly. And so it's going to be everything you need to know about mortgages and the coronavirus. But before we do that, there are two quick things I want to talk about, like almost two very mini pieces that I'll go straight into, Andy. And one of them Andy and I have been talking about before we came on air is the number of coronavirus based scams that are doing the rounds. And some of these are emails, text messages, people actually turning up at your door, normally doing things like asking for money for, whether it's tests or some sort of tax rebate you're entitled to, all sorts of things that they're trying to get you to click on links or give them personal information. So do be aware. I mean, there's so many of them out there that it'd almost be impossible to cover them because they're so ingenious, these fraudsters. They create new ones all the time. But if you get a text message, don't click on any links. If it looks like it's coming from the government, because we all have had a text message saying to stay indoors with a link in it, which the problem is, I think that adds to the problem in some ways. But just go to the .gov.uk website and all the information will be there, so you'll be able to find out anything. And if you get messages supposedly from your bank, don't go via links or call back the numbers in the text messages. Make sure you call the number on the back of your card, although you'll be lucky to get through at the moment. So you'll be probably better off just going online to their websites.
Yeah, that's right. And like you say, Damien, even people from our own office are getting this. Lauren's had one this week, and I mean, what a time to be sending out text messages like this, but it just goes to show you've got to be extra vigilant. Luckily, she spotted it straight away and shared it with us.
So as Andy says there, I mean, we're even seeing him in the Money to the Masses offices. Well, we're not in the offices, in our own homes. So it just shows how prevalent they are. Now, the other quick piece I want to talk about is if you're listening to this on the day that the podcast is released, then you will almost certainly know, or you may not actually, that it's the end of the tax year. So tax years run from the 6th of April to the 5th of April each year. And you all have allowances and reliefs and things that you need to use. Some of them are use it or lose it reliefs. So things like ISA allowances. If you don't use your ISA allowance in a given tax year, then it's not rolled over to the following tax year. So you have until midnight of Sunday, the 5th of April, to do all the bits and pieces you need to do. Andy's going to put a link in the show notes again. I'm making Andy do a lot of work here, but we've got an end of tax year to do checklist, and I'm going to just quickly run through it. Like I say, the link will be in the show notes because we want to jump onto the mortgage piece because it's the thing that is, I think, particularly important this week. But just a quick run through of some of the things that will be in the checklist. It's covering things like pensions, making sure that you use your allowance for contributions this year. If you want to carry forward any pension contributions from unused annual allowances in past years, there are rules around that, and you will need to do that if you want to use up to the previous 3 years worth of unused allowances. So that is something you have to look into. You might want to pay into your spouse's pension. You might want to boost your state pension with additional national insurance contributions. All these things are in the post, but they are things that some people might not be aware that they should be thinking about. In terms of allowances, then you've got your annual allowance for your ISA, so cash ISA, stocks and shares ISA. You basically got 20 grand, which you can shelter in these different types of ISAs. Some people might want to use their capital gains tax allowance. Some people might want to open a junior ISA. There are some people who might, even in this environment, be interested in different types of tax incentivized investments like VCTs. But some of the key ones from a tax perspective, which impact a lot of people, are things like the marriage tax allowance. Now, I did a video the other day about this, but I'm not going to go into detail here, but there's a tax allowance that allows people who are married or in civil partnerships where one of the spouses maybe doesn't use their allowance because maybe they don't work, and the other spouse is a basic rate taxpayer. They can actually transfer some of their unused tax allowance across to the tax-paying spouse. Ultimately, what it means is that you can get £250 off your tax bill for the working spouse, but it means they can actually claim back for previous years where they were eligible. So that's up to like £1,150 you could have in your back pocket in total in terms of tax relief and a rebate. So do read about that. And of course, the other thing to bear in mind is inheritance tax. It is in reference to, or a lot of the allowances are in reference to tax years. So if you wanted to gift any money away or anything like that, full details are in the post that Andy's going to link to. So have a look at that. I suppose that's it, Andy. I suppose we want to go on to the mortgage piece. But before we do, I mean, do you want to just remind people about ways to review the podcast? Because we've not had any reviews of late. It seems like as people have gone into lockdown, they've forgotten how to review the podcast.
Yeah, that's it. So get on to iTunes. iTunes is the best place to review it because that's where everyone knows that they can go. And we've got hundreds of reviews in there, but it's not enough. We haven't seen any reviews, like Damien says, in the last couple of weeks. Now, why not? So head over to there. Pop in. Apparently, you need to put 5 stars on that review because that's the only way. That's the only way you can unlock special member reward. No,
Andy will always say on the podcast, "No, I won't put that in there," and laughs. And of course, I'm talking now because I want it put in there, Andy. Why not? We all need a laugh in this environment. But yeah, obviously, you can put in whatever you want in the review. But yeah, we do like to keep a note of how many 5-star reviews we have. That's all I'll say.
So that's it. We'll go into the main part of the podcast now, which, as a reminder, is Damien talking to mortgage expert Will at Habito about all the questions that you guys have been concerned with around mortgages. Obviously, it's a trying time at the moment with the coronavirus and everything else. So here it is.
So welcome to our Q&A, Will.
Thank you. It's good to be here. So thanks for the intro. So my name's Will. I'm one of the mortgage experts at Habito. So just to give you a little bit of context of who Habito are, we're a online brokerage that is completely free. A lot of people think it's all done by a robot, but you will actually speak to a human expert that will guide you through the whole process. And it's not just the mortgages we can help with. We can also help you with things like solicitors and what surveys to go for. So I hope everyone is staying safe. I really hope you find this useful, and I'm looking forward to answering any questions that you've got.
If I just kick off then, a lot of people are obviously worried about their mortgage payments in the current environment. And so what can people do, Will, if they're struggling with mortgage payments?
So over the last few weeks, what we've seen is a number of lenders that have been announcing that they're offering payment holidays. So a payment holiday is a temporary break or reduction in your mortgage payments, which are typically over 3 months. Now, the government on the 17th of March actually announced that every lender should offer these payment holidays to their customers. And it's usually for people that are up to date with their mortgage payments that can apply for a payment holiday. However, given the circumstances and what is happening, it's always best just to speak to your lender firstly, explain your situation and why you feel that a payment holiday would be suited and why it's needed. And they'll be able to explain, what are the next steps and how to actually get that process.
So on that, I mean, I want to just dig in a little bit deeper on that whole mortgage holiday thing. One of the things we've had in the Facebook group, we've had 1 or 2 people start to suggest that they don't really need a mortgage holiday now, but they kind of like the idea of not having to pay their mortgage for 3 months and keeping the money in case they need it in the future. And I suppose that leads on to the idea of really the pros and cons, but also the impact of doing it, because there will be implications of somebody taking a mortgage holiday, regardless of whether they need it or not. So could we just touch upon that?
Of course we can, yeah. So for me, a mortgage is a great way of or means of buying a property, but in reality, no one really wants a mortgage. They actually want the house. And my advice would always be to get rid of the mortgage as soon as you possibly can. So if you're in a position to keep paying your mortgage, then I'd absolutely recommend to keep doing that. If you take a payment holiday, you would still need to pay the money back, and that can be arranged with your lender. So typically what they'll do is they'll extend your mortgage term. So if you took a 3-month payment holiday, then your term would be extended by 3 months. Or what they would say is they'd arrange for your mortgage payments to be ever so slightly higher. So you're paying back that money over the remainder of the mortgage term. But it's important to note that interest is still going to be calculated. So I would try and avoid taking a payment holiday if at all possible. But, it's a great option to have if you're struggling or you've got concerns about your job or the future. Perhaps there's children on the way, etc. So go for a payment holiday if you absolutely need it. But, if you're just concerned, I would suggest speaking to your lender, just explaining, why you're concerned. And it might not be a payment holiday is the best thing for you. Or they could perhaps look at a temporary reduction in your payments, or perhaps they would say you only pay the interest part of your mortgage repayments, just to ensure that, you're at least still paying some of your mortgage off, or at least paying the interest.
So as you're suggesting, there are other options rather than just taking a complete holiday. But obviously thinking about the implications of taking a mortgage holiday going forward. So if you take a mortgage holiday now and you had plans in the future that you wanted to remortgage or anything like that, then presumably there's going to be impacts on your ability to do that in the future.
Yeah, and I think it very much depends on the circumstances that sit behind why you're applying for a payment holiday. If we look at a worst case scenario, if you were very unfortunate to lose your job, then when you apply for a remortgage in the future, the lender is going to ask you, what are your current circumstances? And they would assess whether it's suitable to lend you money based on those circumstances. And obviously, if you don't have a job currently, then it's very unlikely you're going to be able to get a mortgage. I think given the what's going on with coronavirus currently, lenders are doing everything they possibly can to try and help people and put them in a good position, if you like. So I would say it's very much based on your circumstances. If it was just a case that, you were concerned about what's going to happen and you wanted just to keep the cash flow coming in and have a bit of a buffer, then that wouldn't really affect your chances of applying for a remortgage in the future. Because if you were to apply, you're still employed, you've still got a stream of income coming in. So as long as you meet their affordability guidelines, then there'd be no problem in getting a mortgage. Just one thing I did want to mention, that some lenders, if you took a payment holiday in normal circumstances, they can impact your credit score currently, based on the current circumstances. So it's just something to bear in mind, but always double check with your lender to see any impacts on your credit score. So
just to reiterate that, Will, because I think you broke up slightly, because obviously we are having to record all this with everybody online draining the internet. But basically what you're saying is that in normal circumstances, it could possibly impact your credit rating. But obviously now is the case where the government's intervention, that it shouldn't impact your credit rating. So you just need to make sure it doesn't.
Exactly right, yeah. Always double check with the lender, but no, it shouldn't affect your credit score based on the current circumstances.
I mean, one thing just to quickly touch on there as well. So let's say you took a holiday. Would you be required to repay the money, so to make good that period, if you were going to move to another product in the future? So in the short term, so say you were going to do it in 4 months' time, would your lender therefore want you to have, the new lender would want you to have obviously made up the holiday break?
Yeah, exactly. So if you were to remortgage, and that's when you were moved to another lender, then what would happen just before you remortgage, you would get a redemption statement, and that is how much is outstanding. So therefore what needs to be paid off by the new lender. So yes, that would still need to be cleared. However, you could look when you approach the new lender to get sufficient funds, so borrow enough money to cover the outstanding mortgage and any money that has accumulated as a consequence of the payment holiday. If you were going to do what's called a product transfer, which is just getting a new rate, so whether that's a fixed rate or a variable rate with your existing lender, then the terms pretty much stay the same. So the outstanding amount is still the same, but it's just they'd put you onto a new rate, whether that be a fixed or a variable rate.
Okay. One of the things, we'll come back to later about what's going on generally with the mortgage market in terms of the availability of mortgages, because we've obviously seen lots of headlines about mortgages sort of almost seemingly to dry up, that lenders are starting to pull products. We'll come back to that. I think that's an important point later. But while we're talking about people with existing mortgages, obviously the Bank of England made 2 emergency rate cuts in the last month. And so for a lot of people, they're wondering what the impact is for them. So if we focus on those with existing mortgage products, now, what is the impact for them going forward? Okay,
well, I mean, firstly, to give you context on what happened. So the base rate was at 0.75 and it was reduced to 0.25, and that was on the 11th of March. And then, as you said, there was a second base rate cut, which was on the 19th, which went from 0.25 to 0.1%. Now, usually this is the Bank of England base rate is a means where banks can borrow money. So a lot of people are thinking that will have a direct impact on their mortgage, which I'll come to shortly. But banks don't always borrow money from the Bank of England. They borrow money elsewhere. So the impact from a reduction in the base rate doesn't always necessarily have a direct impact on your rate and what you're paying. So if you've got a fixed rate currently, then that will remain exactly the same. It's a fixed rate of interest, and it's usually for 2, 3, or 5 years. So any changes in the base rate won't affect that whatsoever. If you're off the fixed rate, so you've come to the end of that deal and you're now on what's called the standard variable rate, again, it doesn't necessarily mean that your rate would be affected. We've started to see a few lenders, so the Mortgage Works being one of them, Virgin, I believe, as well, have reduced their standard variable rate. But not all lenders have reduced their standard variable rate as a consequence of the base rate cut. Now, if you're on a base rate tracker, And as the name suggests, it tracks the Bank of England base rate, and it's typically a certain percentage above the base rate. Then you will see a reduction in your payment. It's usually 1 month after the base rate has been cut. However, it's always best just double checking with your lender. And what they would do is they would send you out some form of letter or notification, whether that be an email, just to confirm what your new monthly payments will be.
I remember, I have to laugh at this, that when the Bank of England raised interest rates not long ago, because you remember after Brexit, they did an emergency cut and they nudged them back up again. I think my lender was skipping and clicking their heels, because within it felt like an hour of that happening, I got a text message from them saying, we'll let you know what's going to happen when now the rate's gone up. And of course, we've had 2 emergency cuts this time, and I barely heard anything from them. It eventually comes via letter, but it almost feels like it's a begrudging, because it's obviously pulling down the rate because I'm on a tracker. So it just makes me laugh that when the rate comes down, that lenders aren't necessarily so keen to pass these things on or tell you. I know they've got to, but it does make me smile. While we're on the talking about mortgage lenders, we might as well deviate onto that about the mortgage market more widely, about what are you seeing in the mortgage market? Because obviously I've seen headlines saying that firms are pulling their loan to values down, so they're only offering mortgages to people perhaps who've got the largest amount of equity in their house. So the idea is causing people to think that the mortgage market is almost broken or stopped. So what are you seeing from your end?
I mean, you're absolutely right. Lenders, they have started to withdraw some products. So I think it's probably best I give you a little bit of context about what has happened and why. So, as with many businesses and industries, coronavirus has required people to work remotely, and it's no different for lenders, and they deal with a hell of a lot of applications on a day-to-day basis. So logistically, for them to move all of their workforce to work from home, that has kind of drained their resources and meant that they can't deal with as many inquiries. The other thing to mention is, going back to what we said about payment holidays, they have understandably been inundated with calls about payment holidays, and rightly so. They want to serve their existing customers and not have huge wait times for the customers to apply for these payment holidays. Another thing to mention is that the mortgage market is highly competitive, and what you see is if you've got a lender that has got very good products and they withdraw those products, then it means the next lender down the list, which are offering competitive mortgages, get all those mortgage applications, and it puts a lot of focus on them to try and service those, so their service levels will go up. And it's had this domino effect on one lender withdrew products, and then a number of other lenders kind of followed suit. That partnered with, which I know we'll come on to later, surveyors not being able to do physical valuations, and a lot of solicitors not being able to work as they usually would. Then can we actually process these mortgages in the right way? To add a little bit more meat to the bone, higher loan to value products, so they are products with a smaller deposit, so 5%, 10%, 15%. We've seen a lot of those have been removed from the market for now. And it seems that lenders, they're still open for business, and they still can help you with mortgages. But it tends to be, and this is from the lender's perspective, lower risk mortgages. So that's usually those mortgages with a 40% deposit or 40% in equity or higher, because they can do what's called an AVM. So that's an automated valuation or a desktop valuation that's done via a computer. So they can underwrite the case and they can do the valuation all from, their home if they like. So yes, we have seen some products withdrawn. It doesn't mean that it's complete lockdown and lenders aren't lending whatsoever. And what we're actually starting to see is a couple of those lenders that removed their rates early on have now found their feet, and they're starting to slowly reintroduce certain products. But yeah, there's no denying it that there are less products out there than there were 3 weeks ago.
So one of the things that I see a lot of people speculate is, are the lenders basically pricing in a house price crash? And I know we don't want to get into it's a kind of how long's a piece of string question about house prices, but it is obviously relevant to what we're talking about. And so is your view, or how much do you think of what's going on in the mortgage market is related to actually them worrying about risk and price drops, or, like you mentioned previously, down to just almost service levels that they're able to maintain?
It's really difficult to say, is my honest answer. And I would say that anyone that says they know what's going to happen with house prices, it's probably telling a little bit of a porky, because it's completely unknown as to what's going to happen. Perhaps it would be naive to think that lenders wouldn't factor that in, but Personally, I strongly feel that lenders are doing what they possibly can to look after their existing customers, try and maintain service levels, and as much as possible, try and keep to business as usual. So yes, that may be a factor, but I certainly think, and this is what I've read in a number of different places, that we don't know the impact on house prices. We don't know whether they'll fall, go up. So possibly, but I wouldn't say that's the sole reason there.
Okay, because I mean, just to sort of back up what Will's saying, I mean, I've read so many things where people are starting to speculate that what's going to happen to house prices, and the problem you have with that is if you have no transactions really, or very limited data for transactions of houses for a period of time, it means it's very difficult to work out what the value of a house is. So we're not going to really know until we get out this period what's going to happen to them. So I know that's not really helpful for people, but it's a very it is an unprecedented time where we've had people unable to go and view houses and estate agents having to close their doors or limit what they can do. But on that, I think that leads quite nicely into people who are looking to buy and sell properties. So, I mean, I don't know how you want to tackle this, Will. It's up to you whether you want to do it on about the different stages of where people are in the process. But I mean, if people are looking to buy and sell a home, should they?
Yeah, I think you're right. I think it's worth tackling it in terms of what stage they are currently at. So it is still very much possible to buy and sell property, but things will be a lot slower. As you just alluded to there, that solicitors aren't able to work in the same ways that they have done previously. A number of estate agents have had to their door. But, if you've got a transaction that's going through currently, then what I would firstly suggest is engage with the vendor, so the person you're buying the property from, and just see if you can amicably agree a later stage for when you're looking to exchange and complete. I think there needs to be awareness, which there is, that things will take a hell of a lot longer, and try and delay things so people can maintain sort of social distancing and try and get past the storm, so to speak, before they actually move into the property. So it's still possible, but it would take longer. If you are just starting the actual process and you're thinking about putting your property on the market, or you're thinking to buy a property, again, it is still possible. It's going to take a lot longer. And it's probably not advisable to do that now, and it's probably best to weather this storm and then start to look to put your property on the market or look for properties.
One of the things that obviously there'll be people who've had mortgage offers just before this has come along, and they won't necessarily have a property or actually got further down the line or whatever, a part of the process, but they've got a mortgage offer. What's the general view of what's happening with mortgage offers from lenders? Are they extending them? Are they pulling them? Yeah,
so if you've got a mortgage offer already, that won't change. So that's still sort of confirmation from the lender that you're there, ready to go when you need them, when you want to complete on the transaction. A lot of lenders are allowing extensions on mortgage offers, typically for 3 months. And that links into what I was saying before. If you can agree a later exchange completion date with the person you're buying from, speak to your lender, explain the situation, and then what they will be able to do, or should be able to do, is give you an extension of up to 3 months just to enable you to do that.
Okay. We've talked a lot about residential mortgages. I mean, it would be quite good just to touch upon landlords, obviously, because there are a number of landlords within our communities who have been talking about or worried about what's going on with the mortgage market. So what does all this mean for landlords?
So it's very similar, the guidance and how lenders are approaching this. So often if you've got a buy-to-let mortgage, then that mortgage is in effect paid via the rent that's coming in. And we've got to bear in mind that it's not people applying for mortgages, it's people in rented that may be affected by coronavirus as well. And if they can't pay the rent, then obviously that landlord may struggle to pay their mortgage as well. So similar to those with a residential mortgage, they can apply for a payment holiday, and they can freeze or reduce their payments for up to 3 months as well. So the guidance is very, very similar. I think it's worth sort of pointing out that the government have released a pack or guidance for landlords and tenants, which you can find from their website. And it's a very big document. It's not the most exciting of reads, but it's got loads and loads of points that I would recommend you read, which tells you everything you need to know about what guidance is out there for landlords and also to tenants.
Okay, so what I think is good now is if we start to touch upon some of the questions that we perhaps not covered in detail in our general discussion. So I'm going to start running through some of those. There'll be bits that we have touched upon. Yeah. And one of the ones I've got here is somebody saying that they're not working and expect it will take a while in this climate to get a new job. In the meantime, they're hitting the end of their 5-year fixed term mortgage. And their questions are, one, will they struggle to remortgage with another provider? And two, what options will they have with their current provider at the moment to take advantage of low rates?
Yeah, sure. So if you're not currently working, I mean, firstly, I'm sorry to hear that, but it will be very difficult, to be very blunt, to get a mortgage with another lender. When lenders assess affordability, they have to assess it based over the whole mortgage term, which is typically 20, 25 years, for example. So it will be a challenge to get a mortgage with a new lender. What you can do though, and Habito, we can help you with this as well, and we can explain all the options you've got based on your current circumstances. But you can approach your existing lender and look at a product transfer. So that is essentially staying with the same lender, but giving you an option of a new deal. So you therefore won't then revert onto the standard variable rate.
Okay. Next question I've got here is, I mean, they're jumping around topics slightly, but I think that's fine. I mean, one of them is, if somebody takes a mortgage holiday, will it impact their ability to equity release on the property? And if so, for how long?
So it goes back to what I was saying before, and it very much depends on the circumstances that sit around why you took the payment holiday in the first place. If it was just you wanted a temporary reduction and you're still employed, but you needed to increase cash flow, then it won't really affect you whatsoever. If, however, the reason why you took the payment holiday was because you've lost a job, for example, then it would be a bit more difficult, because a lender probably wouldn't lend you any more money if you're not currently working. So it depends on the circumstance. And again, there could be a number of different reasons why you requested a payment holiday. So you can get in contact and you can talk what your potential options are. There's no sort of defined time limit. It would take 3 months or 6 months before you can apply. It's very much based on circumstances.
Okay. I mean, the next question I've got is, I'm going to paraphrase it slightly, but it's to do with deposit. So somebody is looking to buy a property. Now they've got around about 36% deposit on the sort of house that they want to buy. But obviously at the moment, they're not planning on buying for 3 more years. And it's also that's down to personal circumstances. And the question was relating to, at what point does saving or giving more to a lender result in diminishing returns in terms of the mortgage deal? So should they be saving even more for a deposit, or is it not worth going over 30, 40, 50% loan to value? So they're trying to understand the way the lenders work in terms of the sort of bracketing or what the offers they get, because obviously the bigger the deposit, generally the better offer you get.
Yeah, you're absolutely spot on. So I'll walk through the loan to value brackets. And loan to value is the loan you're requesting to the value of the property. So typically, if you've got a 40% deposit, so that means 60% loan to value, that will unlock the best rates that are out there. Anything lower than 60% loan to value doesn't really change the rates a huge amount. So, and those kind of parameters are 60% loan to value, 75% loan to value, 80, 85, 90, and 95. So they're usually in sort of multiples of 5. So if you've got a 40% deposit, I mean, that's fantastic. Well done for saving that sort of money. But that would be my suggestion. Try and get up to 40%, because that would give you the best possible rates that are out there.
Okay. This one is not on the, it's a similar kind of theme, but it's about somebody who has they've got a high value property which they own outright. And will they still be able to take a substantial loan against it to pay for divorce settlement? So they're trying to obviously get as much money as they can. How will the current situation affect my ability to get a loan and its conditions? So, I mean, what's the answer to that particular question?
Yeah, it's very much possible. Lenders are open for remortgages. If it's a high value property, it depends on how much you're looking to borrow. But if you're staying below that sort of 60% loan to value mark, that would probably mean that a lender would be able to do an automated valuation. Therefore, that wouldn't hold anything up, because a surveyor doesn't physically have to go out to the property. So the short answer is yes, that's still very much possible, and we can certainly help you with that.
This next question is quite an interesting one because of the age of the person. Their product is coming to an end in June, but the term ends next year. They're 63 years old, and their bank will not give them another product. What can they do?
Okay, so you've got other options out there. So most lenders will cap the maximum term at age 70, but some will go to age 75, some will go to age 80 and beyond. So we could look at a lender that would enable you to go up to age 80, for example, and that would mean that you could get a 16-year term. So you could have effectively a new mortgage. So yes, it is still possible, and it depends on their current setup. So are they currently working at the moment? Are they currently retired? Are they looking to retire in the short term? Because these are all things and factors that the lender will ask. But yeah, it's very much possible. And what I would suggest in that scenario, particularly if they're on the standard variable coming close to it, is to look at your options now so you can get something set up. So, you don't come to the end of your mortgage term without having something set up ready to go.
Okay. One of the other questions we've got, which is, you're not going to be able to give a definitive answer in a way, but an opinion would be, people would value that. They're a first time buyer and they said, will it be a good time to buy a house when this is over, or will it be best to wait until things recover? Will the mortgages, loan to values increase again? I think what they're getting at here is it better obviously wait until the market and everything is back to almost where it was before this crisis and the deals that are out there? Do you think it's going to get back to that point, is effectively what they're asking there?
Yes, I do. I'm confident that we will get back to that point. I kind of mentioned earlier that we're starting to see lenders drip feed some products back into the market. So yes, I think we will get back to where we were. Quite when that will be is very hard to determine currently. And to go back to, if you're looking to buy a property now, you can still do it, but it will take longer. So just factor that in. And another thing to bear in mind is that if you're a first time buyer, you're going to be at the start of the chain, they call it. So you're not selling a property. If you are involved with a very long chain, that means that you are buying off someone that's then buying off someone and so on and so forth. The more people that are in this chain, the more chances there are of things potentially going wrong. So I suppose my advice would be, have a look at the chain itself, decide whether you can wait, decide whether it's absolutely essential you move now. And with response to the question about rates coming back, absolutely, I'm very confident they will come back. Just, I don't know when.
One of the questions I want to touch upon that's been sent in actually on the live chat feed, and this one we can do a bit more generally. The person said that they're paying their mortgage back as interest only at the moment, and they want to go back onto repayment. The husband's self-employed, and while they're employed, what would you advise? I mean, one thing that would be quite useful to touch upon as well on that is just what the kind of rules for self-employed people when it comes to mortgages. It seems to be, whenever we have discussions in the Facebook group about mortgages and self-employed people, seems to be almost a minefield. What do they need? What sort of evidence? I mean, I know there's no one size probably fits all with every lender, but what's the general advice from you?
Okay, so most lenders, they will require 2 years tax returns, and that's whether you are a sole trader, you have a partnership, or it's a limited company. They will ask for tax calculations, or they're sometimes referred to as SA 302s. Alongside the tax year overviews, which confirm what taxes has been paid. There are some lenders that will accept just 1 year's worth of accounts. So if you've got 1 year's, don't think you can't get a mortgage. But yeah, to open up the door to most lenders, you'd need a minimum of 2 years. But the requirements in terms of deposit are exactly the same. If you're employed, you can get a mortgage with a 5% deposit. But obviously, the bigger the deposit, the better. But yeah, if you wanted to discuss that in more detail, obviously I'd be happy to elaborate on individual circumstances. As part of the question, you mentioned uncertainty. So if you are uncertain with what's going to happen at the moment, and that's perfectly understandable, a suggestion may be that rather than going over to capital and interest repayment now, a lot of lenders will allow you to overpay, and it's usually up to 10% of the outstanding balance per year. So rather than switching over to capital and interest repayment, it might be worth just overpaying as much as you possibly can, and that will reduce the amount of capital or the amount of mortgage that is actually outstanding. So in the short term, overpay as much as you can. And if you can't make that payment, then you can also always just pay the interest only. If you did want to switch fully over to capital and interest, then most lenders are more than happy to do that because it's actually beneficial, because obviously the mortgage is going to be paid off. There's usually a bit of an admin charge, depends on who your lender is to what that will be. But most lenders are more than happy to switch that over from interest only to capital and interest. So yeah, give your lender a call and they'll be able to talk you through exactly what you need to do to get that switched over.
I mentioned, I will just ask you quickly, what's your sort of feedback you're hearing about the lenders and the time that people are spending on the phones? Because I get odd anecdotal pieces of information from different people, and I'm reading saying they're stuck online on the phones for hours, not getting through. What's the sort of view from within the industry? Is that getting better?
Yes, and it's absolutely right. I mean, I've heard similar stories and experienced it myself calling the lenders. So the wait times are extremely long at the moment. That was to be expected because a lot of people were sort of inundating the lenders for payment holidays, which is absolutely fine. We're starting to see that reduce and wait times come down. And a number of lenders have actually put an option on their website to be able to apply for a mortgage holiday online. So if you've got an account with your mortgage lender, so an online account where you can check the balance, check that firstly to see whether it's an option to apply for a payment holiday online before giving the lender a call. And one thing it's worth suggesting is that try and get in contact with the lender before your payment comes out. But if it's, let's say, 25 days before your next payment comes out, then it's not as urgent as someone that's got a payment coming out in the next couple of days. So all I would say is whilst these lenders are going through this unprecedented times, it's worth just sparing a thought for those that are desperately in need to get a payment holiday that might have their next payment coming out within the next couple of days. So just consider that would be my ask before you call the lender, just to help them manage the queue times.
So, I mean, I think that's quite a good way to finish on. And one of the things I wanted to do with this Q&A is to give a realistic picture of where the market is and what help is out there for people and the options, because there are options. I mean, the message that's coming through from this, there are options, but you do need to talk to your lender. And in particular, I do think, I've always been a big advocate of independent mortgage advice, because most people do. I think it's around 70% of people do seek independent mortgage advice, but it's because there's a range of products. Different lenders have different criteria. Basically, there's multiple solutions out there and they may be able to point you in the right direction. So thank you, Will, for all your time on this.
So there it is, Damien and Will talking about mortgages. We hope you found that really useful. We had lots of people log on and watch it live. If you want to actually see Damien and Will do that in person, you can do that. Go to our YouTube channel and you'll be able to find that video there. Again, don't forget to review the podcast if you can. If you want to get in touch with Damien, you can do so. It's Damien@moneytothemasses.com. Twitter, it's @moneytothemasses with a number 2. And of course, join our Facebook community group. We're putting lots and lots of our content in there because it's an easy way for us to structure it and answer people's questions, and you can get your question answered too. So if you haven't done it yet, what are you waiting for?
Yeah, it's a great group. It's a great group, Andy. I think it's one of the things that people need in this time is an understanding community where people are going through the same thing. I think we're getting a bit of a double whammy of when something goes wrong in your life or you're having stress or problems, it's very isolating anyway, mentally, and you can feel like you're the only person. But of course, we're in an environment where you're physically being isolated as well. So we're getting a kind of double whammy. So there are people in there who've had questions around pensions, all sorts of things, that are feeling better about it after having asked other people within the group. And as you say, it's a friendly atmosphere. Of course it is, because it's run by us and we make sure it is, but the members also do. And
and don't forget, it's a private group as well. So if you're commenting in that group, it shouldn't be available for all and sundry to be able to see what you're posting in that group. It is locked down. You have to request to be a part of that group and we can authorize you. And don't forget, even if you don't want the people inside the group to know your question, if it's personal, then you can always contact us, the administrators, and we'll post that anonymously for you. So there's no reason why you shouldn't feel that you can be connected with a group.
As ever, you can contact me at Damien@moneytothemasses.com if you've got any suggestions or questions or anything like that. And one thing I want people to think about, if you enjoyed the piece with Habito, then let me know if there's any other areas or niches where you would particularly like questions answered. I'm toying with the idea of trying to get somebody who's an accountant, or somebody who's got good nuanced knowledge about the impact or the sort of help for businesses and things like that that's out there at the moment with the coronavirus, because it's changing all the time and a lot of it is being left to interpretation. And as people apply it to businesses, the accountants that is, then they are often the best person to speak to when it comes to understanding how this is all being interpreted. So it's something I'm toying with, but I've got to find the right person. Anyway, that's it for this week, Andy. As ever, like you say, review the podcast and we will see you next time.
See you next time.